Have you ever opened your investment app, looked at the numbers staring back at you, and thought, okay, but am I actually getting anywhere? Maybe you've got a few grand tucked away. Maybe you've been at this for a while and finally crossed 20 or 30,000. Either way, that $1 million goal still feels ridiculously far off, right? But here's the wild part. Once you hit $100,000, you're way closer to millionaire status than most people realize. Like, mathematically, you're already 1/3 of the way there. And yes, that sounds suspiciously generous, but the math is very real. I'm Vanessa, and I spend an honestly concerning amount of time thinking about money, investing, compound growth, and why so many smart people still feel financially stuck. If you actually want to understand how wealth gets built in real life, instead of just crossing your fingers and hoping it somehow happens, hit subscribe. And if this video helps you see money differently, tap the like button too. Now, before we get into the numbers, let's talk about how most people picture building wealth. They think it's a straight line. Totally clean, totally simple. Save $1, move $1 closer to the finish line. Save 10,000, you're 10,000 closer. Save 50,000, same deal. Easy. Except, no, that is not how this works. Not even close. And honestly, that bad assumption is exactly why so many people quit too early. They check their account after a few years of investing, see a balance that feels tiny compared to the giant goal in their head, and think, cool, at this pace I'll be 97 before I get rich. And to be fair, if money only grew in a straight line, that would actually be a reasonable conclusion. But invested money doesn't just sit there looking cute. It goes to work. It earns returns. Then those returns start earning returns too. And that's where everything changes. This is not some weird internet hustle or financial fan fiction. It's just math. Boring, beautiful math. And it's been turning regular people into millionaires for a very long time. The crazy part is most people either don't understand it, or they hear it and assume it's one of those things that only works for somebody else. The whole game comes down to compound interest, which people love to say Albert Einstein called the eighth wonder of the world. Did he actually say that? Who knows? The quote has a very trust me bro energy, but the idea behind it is dead on. People who understand compounding can build serious wealth over time. People who don't usually spend years wondering why they're working so hard and still not getting ahead. So let's make this real with actual numbers. Say you invest $100 every single week. That's about $400 a month. Not pocket change, obviously, but also not some cartoonishly impossible number for most working adults. We're talking about the kind of money that can disappear into things like delivery apps, random Amazon buys, weekend cocktails, or 10 little purchases you barely remember making. Now let's assume your investments grow at an average of 8% per year. That's a pretty reasonable number for long-term investing. With that set up, it takes about 12 years of consistent weekly investing to reach your first $100,000. 12 years sounds long when you say it out loud. I get it. But think about where you were 12 years ago. Life moves whether you're investing or not. Those years are going to pass either way. And during that first stretch, most of the value in your account is coming from you. You're the one doing the heavy lifting. Compound growth is there, sure, but it's basically stretching in the corner and waiting for its cue. Out of that first $100,000, around $62,000 came from your own weekly contributions. The other roughly $38,000 came from growth, which is great. Your money is helping. But at that stage, it still feels like you're doing most of the work. And this is where a lot of people lose the plot. They look at that progress and think, that took forever. Or they get annoyed that the growth doesn't seem dramatic enough yet. What they miss is that they just got through the hardest part. They built the base. They created the snowball. And that base is what makes everything after this move so much faster. Because remember, the goal is $1 million, and you've just reached $100,000. If you think linearly, you'd say you're 1/10 of the way there. Totally fair guess. It's also completely wrong. From here, your money starts pulling a lot more weight. Those returns that looked kind of sleepy during the first 12 years start getting louder. The next big milestone is $200,000. And this part surprises almost everybody. It only takes about 6 more years to get there. That's worth saying again. Going from $0 to $100,000 takes around 12 years. Going from $100,000 to $200,000 takes around 6 more. Same weekly contribution, same average return, very different pace. Now you're 18 years into the journey and sitting at $200,000. And this is where the math really starts being your bestie. At this point, you've personally put in about $94,000. The other, roughly $106,000, is investment growth. That means your money has now made more money than you did. Quietly, in the background, while you were living your life. And here's the part that sounds fake until you really understand compounding. At $200,000, you're already halfway to $1 million. Not 1/5, not getting there. Halfway. That's why saying $100,000 is 1/3 of the way to $1 million actually makes sense. Compounding is exponential, not linear. Every bit of growth creates future growth of its own. So the process speeds up as the balance gets bigger. It's like trying to push a giant sled at first. In the beginning, it's all effort and no drama. But once it starts moving, momentum takes over, and suddenly the whole thing feels completely different. So what happens in the last stretch, on the way to $1 million? This is where it gets really fun, and a little addictive, honestly. Over the next 18 years, if you keep making those same weekly contributions, compound growth becomes the main character. By year 36, you hit that 7-figure mark. You've personally contributed about $187,000 over all those years, but your account is now worth more than $1 million, which means over 80% of that total came from growth, not from money you directly put in yourself. Think about how insane that is in practical terms. At that point, your portfolio is generating roughly $80,000 a year in growth, on average. Remember how long it took to build the first $100,000? Now the account is producing close to that much in a single year without you lifting a finger. That's the beauty of this process. It does not require a joyless, miserable life. We are talking about setting aside $100 a week. For a lot of people, that's less about suffering and more about being a little more intentional. This isn't never enjoy anything again. It's make a handful of better choices consistently and let time do the glamorous part. The person who understands this and actually acts on it can build real wealth. The person who keeps waiting for the perfect time, the perfect income, the perfect moment to finally get serious, usually just keeps waiting. And the acceleration gets even wilder after $1 million. By year 45, you're looking at more than $2 million, and the account is producing over $160,000 a year in growth alone. At that point, your money is out here earning a bigger paycheck than a lot of people do. Now, I can already hear some of the pushback. Okay, Vanessa, cute math, but what about inflation? What about market crashes? What if I can't even find $100 a week? Fair questions. Very fair. So let's deal with those. First, the 8% return we've been using is already a conservative long-term assumption. Historically, the stock market has done closer to 10% annually over long periods. We're intentionally being a little cautious here, because building your future on fantasy numbers is how people end up making very bad retirement decisions. As for crashes, yes, they happen. Your portfolio will drop sometimes a lot. That is part of the deal. But here's what most people miss. If you're investing consistently for decades, downturns are not just bad news. They can actually help you. When prices fall, your $100 weekly contribution buys more shares. Then when the market recovers, and historically it always has over time, those extra shares become incredibly valuable. It's like your favorite store doing a massive sale and everybody panicking because the prices are lower. Long-term investors, should not think that way. The people who freak out and sell in downturns are basically doing the dumbest trade possible, buying high and selling low. Now let's go back to the I can't find $100 a week thing, because I hear that all the time. And look, everybody's situation is different. Some people genuinely are stretched thin. But I also think a lot of people have more money leaking out of their life than they realize. Take food spending. A lot of households burn through a shocking amount every month, between groceries, takeout, convenience stops, and those I'm too tired to cook orders that somehow become a habit. Trim that spending by even a modest amount, with better planning, a few more home-cooked meals, and less impulse ordering, and you might uncover enough to fund a big chunk of your investing goal. Or look at recurring expenses people barely question anymore. Fancy phone plans, subscription stacks, gym memberships they ghost harder than a bad Hinge date, premium upgrades for stuff they don't even use. I'm not saying cut every pleasure and become a minimalist monk in beige linen. I am saying most budgets have more wiggle room than people think. A lot of this comes down to lifestyle assumptions. People normalize spending patterns that aren't actually helping them, then act like investing is the unrealistic part. That's backwards. And here's something else that makes the process easier. Once you start, watching your money grow is weirdly motivating. In the beginning, investing feels like delayed gratification. Later, it starts feeling rewarding in real time. You notice the account moving. You see what your contributions plus growth are doing. And suddenly you don't view investing as money disappearing. You view it as money multiplying. That mindset shift matters a lot. Because once you feel that, you start looking for extra ways to feed the machine. Maybe your next raise doesn't automatically turn into more spending. Maybe your tax refund goes into investments instead of a vacation you barely remember 6 months later. Maybe you pick up freelance work or sell something on the side and funnel that cash straight into your portfolio. When you can literally see your money growing while you sleep, it becomes much easier to prioritize. That's one of the biggest differences between people who build wealth and people who stay trapped in the same spending cycle for decades. Wealthy people don't magically have different math. They just think differently about money and time. They understand that every dollar has a future version of itself. So a random $100 spent today is not just $100 gone. It's whatever that money could have turned into after years of compounding. Now let's talk about why hitting $100,000 feels so huge psychologically. Because honestly, it is huge. There's something about seeing 6 figures in an investment account that flips a switch in your brain. Before that point, becoming a millionaire can feel abstract. Like a nice idea, cute in theory. Once you cross $100,000, it starts feeling possible. Before that milestone, a good year in the market might add a few $1,000s. Nice, sure, but not exactly jaw-dropping. After you cross 6 figures, annual growth can be $10,000 or more. In especially strong years, you might see gains of $20,000 or beyond. At that point, this stops feeling theoretical. It becomes real enough to change how you think. That's why people love quoting Charlie Munger about the first $100,000 being the hardest. And honestly, he was right. Not just mathematically, though yes, mathematically too. It's also the hardest, because that first stretch forces you to develop the habits that make wealth building possible in the first place. The person who builds their first $100,000 has already shown they can delay gratification. They can stay steady during market chaos. They can stick to a plan when results are boring. Those are the exact traits that make the next stages easier and more powerful. And then there's the opportunity piece. Once you've built meaningful savings and investments, you get options that people living paycheck to paycheck simply do not have. Maybe a job opens up at a smaller company with more upside but less guaranteed cash. Maybe you want to launch a business. Maybe there is a great real estate deal or some other opportunity that requires capital and quick action. Those chances come up all the time. But they mostly go to people who actually have financial resources ready. That's the irony. The same discipline that got you to $100,000 is what makes the path to $1 million more realistic. You already know how to live below your means. You already know how to ride out volatility. You already know how to focus on long-term payoff instead of short-term dopamine. And here's the other thing. Your contributions probably won't stay at $100 a week forever. Most people earn more as they move through their careers. So the person investing $100 a week at 25 might be investing $250 or $400 a week later on, which means these projections are often more conservative than reality. But here's something a lot of financial people don't say clearly enough because it's not sexy and it doesn't sell nonsense. The hardest part of this whole thing is not understanding compound interest. It's not finding the perfect fund. It's not predicting the market. It's learning how to stick with a boring plan in a world that is constantly screaming for instant gratification. We live in an everything now culture. Instant delivery, instant approval, instant entertainment, instant payment plans for things people absolutely do not need. Waiting decades for wealth sounds offensive to a lot of people. They'd rather finance a flashy SUV today than drive something modest and invest the difference. They'd rather replace a perfectly fine phone because the camera got 11% better. That's a huge reason most people never build wealth. Not because they're incapable, not because the math doesn't work, but because they were never taught to value delayed gratification enough to let compounding do its thing. And the people who do build wealth usually aren't geniuses. They're not all stock-picking wizards. Most of them just commit to consistency. They understand that slow, boring, repeatable actions beat exciting speculation almost every time. While everyone else is chasing the latest shiny investment obsession, they're just quietly buying broad index funds and moving on with their lives. And let's be honest about one more thing. The math I've shown you assumes you never raise your contribution amount, never get employer matching, and never toss in extra money from bonuses, refunds, or random windfalls. Real life often looks better than that. Maybe your employer gives you a match in your retirement account, which is basically free money. Maybe you get a big commission check one year. Maybe you inherit something. Maybe you start a side hustle and decide that income is all for investing. None of that is included here. We kept the math simple on purpose, and usually simple is underselling what's actually possible. Now, some of you are probably wondering, what kind of investments make this strategy work? Totally fair. Because 8% is not guaranteed, and bad investment choices can absolutely mess things up. But the good news is, this does not have to be complicated. For most people, especially beginners, a low-cost index fund that tracks the broader market is more than enough. You do not need to outsmart Wall Street. You do not need a genius stock-picking strategy. You just need to participate consistently. Over long periods, matching the market has built more wealth than most fancy strategies ever will. The S&P 500 has delivered strong long-term returns across decades of recessions, crashes, wars, and chaos. Could the future look different? Sure, of course. But betting against long-term human innovation, business growth, and productivity is not a bet I'd personally feel cute making. The biggest trap is getting too fancy. Individual stock picking, chasing trends, jumping in and out based on headlines. I just think of wealthy, living with my parents is open to my mind. Trying to be clever usually hurts more than it helps. The investors who win most often are usually the ones doing the least dramatic stuff. So yeah, hitting $100,000 is not just a nice round number milestone on the road to $1 million. It's proof that you've already done the hardest part. And mathematically, you're about 1/3 of the way there. The numbers are real, even if they sound a little ridiculous at first. Time and compound growth are ready to work for you. But only if you actually start. Start now. Stay consistent, because 36 years from today, you're either going to be really glad you did, or you're going to be sitting there wondering why you waited.